Is the market showing signs of improving or weakening? Stay tuned. Welcome to this week's edition of NoteSchool TV, where every week we bring you, the most amazing episodes. This is episode number 215. Yes, 215. And we have the fan favorite, which is the monthly update. So we will jump right into that in just a second. But before we do, let's do a couple of little housekeeping items. Make sure and like this episode. Yep, make sure and hit that like button. Make sure and share this with all of your friends, because we are going to be, we're going to be deep diving today on whether the market is improving or weakening. So make sure and share it with all your friends. If you have not already joined the NoteSchool TV channel, just make sure and do that, and make sure and hit that bell notification. Yep, boom, so that you'll be aware of when we go live. When? Every Wednesday at 11:05 Central Time. With that, let's bring on NoteSchool's founder, Chief Visionary Officer, all-around good guy, Mr. Eddie Speed.
Good morning, Joe.
Good morning. How are you?
You know, I met somebody at a class the other day, and they said, and they could mimic me saying, "Good morning, Joe."
Yes, he could.
Do you remember that?
Yeah, I certainly do.
Well,
that's the first thing he said to me. Good morning, Joe. Yeah.
Well, it's market update, and
it's November.
I like your teaser because we are getting some indications in the market. Boy, our end of the year, this one's going to be really good, Joe, but our end of the year is going to have, it's going to have a lot of data in it. We're already working at that, right? We've
got a really high level report that we're going to be sharing with you guys. So
so watching this market update is going to be kind of a precursor of how we're kind of leading up to it. Some of the details that we're going to have in here, you're going to need. This is probably, Joe, this could be the most detailed report we've done this year.
Yep.
And so we're really turning it up as the market is showing us signs and directions. We're trying to really turn it up and do it. I just left a phone call a little while ago with a super seasoned real estate investor, and he commented on our NoteSchool TV, this market update we do once a month, and he says, "You guys scrape a lot of data." And I said, "Let me tell you something. We're really interested in knowing the real weather report."
We really are. Yeah.
All right. So let's get after it, Joe.
No fake news. No fake news here.
Yes, sir.
All right, let's do it.
All right. So it's doing the right thing at the right time. And the only way I think you can do the right thing at the right time, Joe, is you have to have the right information.
You got to have the right information.
So like market timing is everything, but you have to know what the timing of the market is. So one thing that we talk about a lot is this has all changed a lot. And, Joe, I started back here in 1980 and rates were, 18 to 20%. And then all of a sudden in the 90s is when really right about here in the 90s is when the bank crash happened. And then all of a sudden in here, everything was blowing and going until, oh my God. Right?
Yep.
That was in 2008.
Yep.
And then we saw the market crashing and then start kind of recovering, starting right about here in the middle of 2000s.
Yep, that's right.
And it ran like a son of a gun through 2000, really 21 and 22. And then all of a sudden, the last couple of years, we've seen inflation and we've seen this. And Joe, here, I'm going to make a statement to you right here, right? Inflation beats supply.
It does. It does.
Right? In other words, everything about the market that we know, the rule in every business is supply and demand. Supply and demand is everything. Actually, inflation can beat that number.
That's right.
we're gonna talk about that point today. So let's talk about the housing market, Joe.
So Eddie, this is Lennar was reporting, and by the way, Lennar is the biggest home builder in the U.S. Their incentives in this last third quarter jumped to $48,100 per house, and at the same time, prices dropped 5.8% year over year to $422,000 per home. So that's buying the market, isn't it?
Well, I think what you're seeing is for new home builders is that right?
Yep.
And so understand that.
Look at that last bullet point down there, Eddie. The highest supply since February of 2008. And there was a lot of supply of houses sitting around back then.
Yeah, so we're watching it. There's a DR Horton. There's a YouTube that's going around about them, and their stock really cratered. Is Lennar bigger, or is DR Horton bigger?
If they're not 1 and 2, they probably are 1 and 2. They're both really big.
Okay, and so there's another big piece of press out there about them and their stock prices and stuff. We've been watching this home builder thing for a while. We kind of cooled off on it for a few months. We were really looking hard at it, and this has really become a factor. And there is like big subdivisions out here in Dallas-Fort Worth that like literally they've walled off the rest of the land. They were going to subdivide, and now they're trying to go sell it for something else. So home builders are really taking a high caution flag, let's just say.
That's right.
All right, very different here. We got new home sales and existing home sales. Let's cover each, Joe.
So you look at existing home sales. I mean, it just kind of been dropping like a knife, and we're looking at about 1.450 million. And then look at the new home sales, with the average being, what is that, 60 something percent. So anyway, it's going to the moon right now. So.
And do you think that's because they finally hit a price they'll sell at?
I think because of the incentives. When you look at an incentive being over 10% of the price of the house, and you're getting a brand new house, and these incentives could be, upgraded furniture, upgraded appliances, upgraded kitchens, all of those things, people are going to jump to the new construction, and they're buying a rate down. That includes rate buy downs as well.
Yeah. And let me tell you this though, guys. The reason you're seeing new home construction is these builders have got to get rid of the inventory they have.
That's it.
Right. So this isn't like, oh, well, this is so encouraging, and now we're going to jump out there and start a bunch of new starts. Like new starts you're going to see are like very stalled out.
Yeah. I think the banks are going to kind of pull back from that because of supply.
Yeah. Joe, I just wanted to point this out. This started in February.
Yeah.
Okay. So overall, this year, sales have dropped. But guess what hasn't dropped, Joe? Listings.
That's it.
More to say about that, right?
Listings are up. Yep. This is from Wall Street, Eddie, and this guy's he's a smart guy. And he's just saying that the demand destruction for existing home sales is the lowest since 1995, and the highest supply since October of 6 years ago. So 6 years ago, that would have been what, 2018?
Yeah.
And you see, we know it dropped off the map there in about February of 2020.
Yeah, that's when everybody freaked out. But
that's
that didn't
last. Everybody lost their minds. Yeah.
I don't see any springbacks on these ones coming here, right in here, Joe.
No, I don't either. Nope, not for sure. And what this is saying is that basically last year, there was only 17 markets that had more inventory out of the top 200 that had more inventory than they did in 2019. And so now that's jumped up to there are 54 of the nation's 200 largest markets that it's jumped up. So it's, again, that's inventory is going up. I mean, there's no doubt about it.
Inventory is going up, and Joe, the math is saying that we're not pacing.
Yeah.
Right. Inventory is far outpacing sales right now.
Yeah.
Everything that you're seeing overall, that's leading us to that conclusion. Being that this is a chart you've seen us do. Yep. Now we update it every month. Yep. Man, when Joe found this chart, he knew he struck gold.
Yeah, look at that. Look at Florida. 66% increase. That's a lot of condos in that too, because we've got the challenge here in Florida with condos and the new regulations that are going to hit here. But yeah, look, I mean, it's the whole southeast there. I mean, even if you include even Alabama in that.
You know what? I was just talking to a very seasoned investor in Alabama, and he noticed the same thing.
Yeah.
And look at this little run right here.
Yep, that.
Right. These are all up really north of, 33%, 35%, any of those north of there. Of course, Texas, look at here.
Mm-hmm.
Whoops, I should have included Ohio, Colorado too.
Mm-hmm.
And so understand that we've got some areas here that, that have been hot.
Yep.
And, don't know what to say about all that right up there, right?
I know, right?
Look at that. Look at Seattle.
And then look on the north side. Look on the north of on the west coast, northwest.
Yeah.
Washington there.
So anyway, a lot of areas here. This is just listings year over year. Joe, let's talk about. So we're watching all this really close. What we are saying, and we've alluded to it. There's some reports coming in that we're gathering information. It wouldn't, really was a better year-end thing. So we're going to have this like next month as the year-end report. But we're watching what the read is in the market, and these days on the market are issues. Statistically, Joe, we're up 125%. If you look at nationwide, we're up 125%. I read something, Joe, this other day that said 125% listings means over 4 months of days on market increase.
That's it. Yeah, and that's what it's going to. I showed you that when we were in Dallas the other day. I showed you Zillow is saying prices are going to go up 2.9% more next year. We'll see.
Yeah. No, they're never.
So interest rates, Eddie, this is let's call it the conundrum, right? Because we've had, half a point or 50 basis points in September, then in November, 1st of November, we had another 25 basis points down, and we're still seeing rates. Well, you see the trend. I mean, that's what they are.
I don't know what real estate Facebook page you're a member of, but I'm a member of several of them.
Mm-hmm.
And when the Feds announced that rates were going down, people lost their minds.
Yeah.
Like, oh my God, this means that mortgage rates are going to drop through the roof, and mortgage rates have not reacted that way.
No.
And there's a lot of argument as to why, Joe. One thing I would say to you is, the obvious answer is the Fed rate and 10-year T-bill rates don't necessarily run straight with each other. They didn't run straight when they dropped down. They haven't run straight going up. But the other thing is mortgage companies have not been really making a profit.
No.
And so I think the thing is that they're saying, like, we've got to keep rates up so we can go originate mortgages and sell them in the secondary market and make a profit.
That's it.
So it looks like rates are about 7%, and the future doesn't look bright that there's going to be a lot better story than that. You don't need sunglasses, your future self.
No, that's for sure. And then we've got, the rates, you see what the rate is, and then with the APR, we're clearly, and that's for the best borrowers, are over 7%. Actually, today it's over 7, it's 7.02. I was just looking with the APR. Yeah.
All right. And of course, you can see that's on really good borrowers. So that's not subprime lending. All right. Let's talk about treasury rates.
Yeah. So the Fed's target for the 10-year treasury is right in where it is today, right? And then if we look at, and I didn't do one for the Fed funds rate, but the Fed funds rate today is 4.58, and their target right now is 4.5 to 4.75. So they've got it where they want it.
They're not wanting mortgage rates to drop below that.
Yeah.
Because this T-bill rate, this 10-year rate, this is what drives long-term mortgage rates.
That's it.
It's not the Fed rates, right?
That's what the banks can borrow from each other. Yeah.
Yep.
So this is part of that big report. And Eddie, I mean, that basically is saying that, you know, they've reduced the number of rate cuts for up until July of next year.
So these are expectations of rate cuts.
Mm-hmm.
And so they were looking at pretty substantial rate cuts. There's not any.
Right.
But understand they've cut way back. And they're watching these factors, right? They're watching these three factors, and not saying there's not going to be any, but it's not going to be. I'll be honest with you. It's not going to be quite as advantageous as we were thinking. And
you know, Eddie, you and I have talked for a year and a half, 2 years here on these monthly updates. You know, the rate still isn't bad based on what it's been, what the 50-year average is, right? 50-year average is 7.77.
To be honest with you, here's what I would say. For all the people that are sitting around there waiting for rates to get 5% to buy a house, I'm going to say to you, I hope the market just adjusts to the new norm, which is this is going to be normal mortgage rates, I believe.
Right.
Close to it. Like, I think that's the word. All right, let's talk about this.
It just is what it is. So here's another piece from the Fed. Look at unrealized operating losses. Operating losses for the Fed was just a tick under 20 billion for the third quarter. And then the unrealized losses are they're just piling up. So, but they're managing the money. So I guess it's just the old accounting joke, right?
Well, if they were a real business, they might have a real problem financially.
Yeah, for sure. So, but you can see the Q3 2024 there. It's 20 billion.
That this whole problem started back. You can see the big flip in this, right?
It's crazy, isn't it? 2 years ago.
And so obviously trying to pay attention to that and make sure that, you know, but this also affects some of the things that we see with the Fed.
Yeah, it does. It does.
Okay. Applications. Well, they're not doing too good.
I mean, yeah, that's a purchase mortgage is buying a new house, not refinancing, right? So,
yeah. Refinancing's blown up.
Yeah, it has.
It's non-existent, but new homes are just really not good. And, you know, they weren't good in 23, right? No. If you're really, but I mean, in 24, I mean, they're just down. Yeah. They're just down really low. And and what every sign out there we're seeing is it's not really looking different.
No, and remember in 23 a year ago, they were right at 8. It ticked a little over 8. Yeah. You know, this is that, banks are still, or the depositors are still jerking money out of there. In 3 months, almost 200 billion. But you look on down there and it's 6.54 trillion as of the end of October of this year, sitting in money market funds. A lot of money out there looking for a home.
So people, the nervousness of banks' conditions is worsening.
Yeah.
And I'm going to say this to you, Trump can't fix this. Not in the short term.
Not in the short term.
He can't fix it. I mean, I'm a fan of Trump's policies on these things, right?
Mm-hmm. Yeah.
But I'm just saying the toothpaste is already out of the tube on this. And I'm kind of warning my friends. I'm like, hey, I know everybody's fired up and that, real estate activity's up and things are doing like moving and stuff. And for a business owner, I can tell you that's good. And I've seen the same reflection. But what I'm also saying to you is this bank situation, whatever it is, there's not a magic wand somebody's going to wave and fix it. It's going to have to prove itself out.
It's like when somebody tells you the real estate market is up, you say, well, listings are.
Well, and the answer is it's going to get worse before it gets better.
You're right. Yep, 100%.
Right.
Yep. But a lot of money out there. That last bullet point there, that 6.54 trillion, that's a lot of money in dry powder.
People are sitting on dry cash because they don't know what to do with it. Hey, you should buy notes with it, Joe.
They need to buy notes. And we're working on that every day.
All right. So we talk about this a lot, and this is kind of the hole where seller financing seems to be filling the gap. We don't need to convince you that conventional lending is not filling the gap, right? That's pretty obvious, and that's not a shocker that seller financing has had a substantial increase, and for all the reasons that we talk about. All right, let's talk about commercial real estate. This one is a big one.
Yep, for sure.
Joe, top and bottom 5 metros for multifamily. Okay, so here's the top best. Okay, right?
Yep.
Raleigh, Durham.
Yep.
Austin?
No, excess supply is in Raleigh.
Oh, okay. Yeah, these are the worst.
These are the worst. Yeah.
The worst are on top.
That's it.
This is bad. This is good. Oh, Joe, this is very discouraging. These are markets that everybody said was on fire and nothing could change it.
There you go.
Austin, Jacksonville, Knoxville.
Yep.
Right.
And interestingly, those would be the Tulsas, the New Havens, Little Rock. Those would all be secondary markets, right? Those aren't the big markets, but that it's a big deal there, and that's just kind of where they are. And the TTM, guys, just means the trailing 12 months. Yeah, on that slide. Yep.
All right. So the best markets, as we said, are tertiary markets.
Yep.
Little Rock, Hartford, Tacoma, New Haven, and Tulsa. And good for you guys. I hope that you don't take it quite in the chin as hard as some of these other places are.
Right.
This is not a shock. We've been talking about multifamily for 2 years.
Yep, we have.
So if somebody wanted to like fact check us and went backwards on how we've been calling the ball on this, I think we'd stand a pretty good little audit on this one, man.
Yeah, I think we would too. I mean, yeah, for sure. I don't think
we sure have had some naysayers on this one.
Yes, we have. And there's still some of them trying to call that, right? Eddie, I looked at this, and it does have the single family stats in there, which would be the line, the blue line. But you look at the yellow line, that's 5 units or more. And then you look at the multifamily for the 2 to 4, it's almost non-existent.
Okay, so the orange is the multifamily 5 or more.
Right.
Which we're seeing trend down.
Right.
And then the blue is
single family.
This is single family right here, right?
Yep, the blue. Yep. And then the black is multi 2 to 4.
Wow.
I mean, I don't think you can get any flatter than that. So yeah, year over year, 5 units or more starts are down almost 13%, 12.6%. So yeah, I just there's nobody's building. Well, we're calling that, right? Do you want to build a duplex or a tri or a quad, or you want to go buy a note? I mean, come on.
Okay, well, my argument to this is they're not going to cash flow.
No.
And if you have any debt on them, they're not going to cash flow. No. And so people have squashed out on it, right? And multifamily, you know, we're seeing, you know, clearly a rate of people abandoning projects. The problem with multifamily is, Joe, when some syndicator raises the money to do it, now all of a sudden he's, you know, it takes him 2 years to get past all of you get past all the approvals and the engineering and the stuff like that. By the time you start seeing the structure, they're 2 years into it.
Yeah.
And it's hard for them to turn the train around.
It is. And, you know, once they're into them, Eddie, they can't just shut them down and say, well, we'll finish it later. No, they got to finish it.
So,
and then they got to make concessions.
We've seen that boiling over the last couple of years.
Yeah.
Now we're seeing new starts. Clearly, you're starting to see really them tail off for all of the obvious
almost reasons. 13%. Yeah.
Right. So, all right. Delinquency, Joe.
Yeah. So, yeah, 98%, 96.8 were current or less than 30 days, right? Down from 97. But the 90-day plus is up a tick to 2.7, or in REO, real estate owned. They've been taken back. And then, you know, the 90-day, 60 to 90-day pocket there is also up a bit. So, and, you know, the last statement there, Eddie, the share of loans were delinquent increased for some property types, particularly office and multifamily, and decreased for industrial, lodging, and retail.
So these were increased classes, yes. Right? Yep. Delinquency increased here. And then you're looking at these asset classes, which went down. The delinquency on and loan performance, the amount that are trouble went down. So yeah, and I don't think that's shocking. I think it's the only one that shocks me is industrial. Industrial supposedly is headed for a really big bomb.
We've been it's been, you know, whispers of that, but there's a New Hampton Inn or Hilton Garden Inn or Marriott, small Marriott. That lodging thing is still blowing up. It's we'll have to see how that goes, but yeah.
Okay, as our friends at TREP.
Yep. Special servicing rates are up.
So let's just zero in on a couple of asset classes here.
Yep. Multifamily, third one down from the top there, and yeah.
So September of this year, and they're trending up.
Yep.
At the beginning of the year, they were at 3, and now they're at 6.
Yep.
That's kind of like saying it's double, Joe.
It's double, yeah. You can't deny that.
These are special servicing means problem loans. Everybody get what we mean by this? Like this is not a good thing.
Yeah.
Right.
Yeah. It means special. That's a whole new meaning here.
Like, and if you looked at the other asset classes, like compare industrial to a year ago, they're double.
Yeah.
Right. But it's still less than 1%.
Yes.
If you looked at lodging, it's almost the same. It's up a little bit, right? Yeah. Office is up some, like they're all up a little bit, but like multifamily is the only one that's like becoming measurable where it wasn't even a factor.
Yeah.
And I can tell you this, Joe, that just because the lender didn't quote put it in special servicing doesn't mean that it wasn't in trouble.
That's right. That's right.
All right, let's talk about non-performing loans.
You know, Eddie, non-performing loans, it's just, you know, it's kind of status quo for what it's been for many months. The number of delinquent loans has gone up from about 1.823 million in August. And now in October, as of the end of October, we're at 1.988. So it's inching back towards that $2 million mark. And yeah, look at the days delinquent. Yep.
These are all residential loans.
All residential. Yep.
And these are loans in foreclosure.
Yep.
And this shows you how many days they are delinquent. 1,261 days.
Yep.
Joe, I don't know what you think is a long time, but I spent a lot of time in this industry, and I can tell you right now that is a shocking number.
3.5 years.
This is the average days delinquent of a loan that is in foreclosure. The average days delinquent is essentially like 3 years.
Yeah, it's a little over 3. And look at the percentage that are actually in foreclosure compared to the ones that are delinquent. It's about just a little less than 10. It's a little more than 10%. That's crazy. So, the question is when is that inventory going to start moving?
Only the shadow knows.
That was my thought. Yeah, but I wanted you to say it.
All right, let's talk about this.
Yeah, so the delinquency rate, again, 3.3% in September, fell to 3 basis points to 3.34. But it was for the month, but 5.1% up for the year. And look at the serious delinquencies. Loan 90 plus days, but not active foreclosure, rose by 14,000. Again, that's out of almost 2 million, right? And then the seriously delinquent, nearly 70% are still protected from foreclosure via forbearance, loss mitt, or bankruptcy.
Yeah, so this is the one that people keep wondering about right here, right?
Right.
This is the what's going to happen, because these are loans that are seriously delinquent, and yet they've not gotten moved to the foreclosure status. It's a possibility, Joe, that was very politically driven, and it's a possibility that's pretty drastically going to change starting Q1 of 25.
Yeah, pretty quick.
Does everybody get that?
Yeah.
Like if it were politically driven and lenders are just, let's just be honest with you, they're just throwing good money after bad.
That's it.
And because the borrowers are not going to be in a position to do it, we've had an increase in inventory. We've had a decrease in escalation of values, some in cases, a decrease in values, period. And so once again, it's kind of like cooking the pie that's already burnt doesn't get the pie less burnt.
That's it.
Right. Continuing to cook it doesn't necessarily solve its problem. Right.
And, Eddie, so, the first few words of that fourth bullet there, the rolls to earlier stages fell a little bit, which fell right in with the numbers that we were looking at a minute ago, while cures from 30 to 60 late worsened by almost 12%.
Yeah. So that means they're rolling from one level of delinquency status to the next level of delinquency status, the higher number of days delinquent. It starts going that way. And so what they're saying is it's trending the way that we've been concerned. And once again, we got decades in this business and stuff, but this is what gives us the weather forecast of what's going to happen.
Eddie, well, maybe we'll see some non-performing loans come across the board. But yeah,
pretty sure we are. Yep. Happy Thanksgiving. Look, we got a lot to be thankful for in this country. And we start out every executive meeting in my shop and we talk about what we're thankful for. And I just want to challenge you. If you find yourself kind of worried about how life isn't perfect, you're never gonna go find the good. Right. And so for all of us, this is a lesson to all of us. Like, let's go be thankful and let's enjoy this week, enjoy your family and your loved ones, and enjoy God's blessings. And we'll figure out this market. There's going to be big opportunities. I believe that. But just go spend a little time and enjoy your family and and this great Thanksgiving holiday. Happy Thanksgiving to you guys.
Eddie, I got to say this. You're going to have 5 under 5, right? 5 grandkids under 5 at the house.
I got one that's 5.5, but I've got
okay, he's
5 there.
so cold as yeah. Okay.
Yeah, so we got a little. The speed house is going to be fairly disruptive.
Yeah.
You know what I'm saying?
Absolutely. Yep. Let's be thankful, and we'll see you guys same place, same time next week.
Happy Thanksgiving.
Bye now. Happy Thanksgiving.